Hey everyone, and welcome back to the channel. Today, we're diving deep into the world of precious metals, specifically gold. It's been a fascinating ride for gold prices lately, and a lot of you have been asking what's driving the market. So, let's break it down. Recently, we saw gold prices get a nice little boost. Why? Well, a big part of the story is the US dollar. The dollar took a bit of a dip, and when that happens, it's usually good news for gold. Think of it this way: when the dollar is weaker, it becomes cheaper for people holding other currencies to buy gold. This increased demand naturally pushes the price up. It's a classic inverse relationship that seasoned investors watch very closely. But the dollar isn't the only piece of the puzzle. There's a lot of anticipation buzzing around the US Federal Reserve. Everyone's got their eyes peeled and their ears open for any hints about what the Fed will do next with interest rates. The general feeling in the market is that the Fed might be done with its rate hiking cycle for now. We saw some pretty significant hikes over the past year or so to combat inflation, but now, the focus is shifting. Let's look at the data. Recent economic numbers, like the US Consumer Price Index or CPI, have shown that inflation is cooling off. It came in a bit softer than expected, which reinforced the idea that the Fed's aggressive strategy has been working. So, when interest rates are high, other assets like bonds, which do pay interest, become more attractive. This is what we call a higher opportunity cost for holding gold. But when the expectation is that rates will stop rising, or even start coming down, that opportunity cost shrinks. Suddenly, holding a non-yielding asset like gold becomes much more appealing. Market analysts are now putting the odds of another rate hike in December very, very low. In fact, the conversation is already shifting to when the Fed might start cutting rates. Some traders are even pricing in potential rate cuts as early as the first half of next year. If and when that happens, it could be another major tailwind for gold, potentially pushing prices even higher. It's a classic setup. Investors who are maybe on the sidelines are now looking at gold as a more attractive safe haven asset again. Gold has always been seen as a store of value, especially during times of economic uncertainty. While the immediate threat of runaway inflation seems to be subsiding in the US, there are still plenty of geopolitical and economic question marks around the globe. In these situations, investors often flock to gold as a reliable hedge. It's tangible, it has a long history of holding its value, and it's not tied to the performance of any single company or government. What's happening on the technical side of things? When we look at the price charts, we can see some interesting patterns. Gold has been testing some key resistance levels. Right now, many analysts are watching to see if gold can establish a solid foothold above the crucial $2,000 per ounce mark. If it can consistently stay above that level, it could signal a new bullish phase for the metal. However, it's not all a one-way street. Any unexpected economic data could shift the Fed's stance. For example, if a future inflation report comes in surprisingly hot, it could spook the market and bring the possibility of more rate hikes back onto the table. While the US Fed is a major driver, what the European Central Bank or the Bank of England does also matters. Global monetary policy is interconnected, and major shifts in one region can have ripple effects everywhere, including in the commodities market. And let's not forget about physical demand. Beyond just investors and traders, there's the jewelry market and industrial applications. During festival seasons or periods of strong economic growth in these countries, we often see a surge in physical gold buying, which adds another layer of support to the price. Central banks themselves have also been major buyers of gold in recent years, looking to diversify their reserves away from the US dollar. This trend of official sector buying provides a strong long-term floor for the market. So, what's the key takeaway from all of this? The current environment looks pretty favorable for gold. The combination of a retreating dollar and the market's belief that the Federal Reserve is nearing a pivot on interest rates is a powerful one to punch. Investors are recalibrating their expectations, and gold is shining brighter as a result. However, as with any investment, it's crucial to stay informed and understand the risks. The situation is fluid. Economic data will continue to be a major focus, and any surprises could lead to volatility. The path forward will depend heavily on the incoming reports and the subsequent commentary from Fed officials. The interplay between macroeconomic data, central bank policy, and investor sentiment is on full display. Keep an eye on the dollar index. Listen closely to what Fed Chair Jerome Powell and other officials are saying, and watch those key technical levels on the price chart. These will be your best guides to understanding where the price of gold might be headed next. The story of gold is never just about one thing. It's a complex narrative woven from economics, politics, and human psychology. Right now, the chapters are being written by inflation data and interest rate expectations. It will be exciting to see how the next part of the story unfolds. If you found this helpful, please give this video a thumbs up and consider subscribing for more market analysis. And as always, I'd love to hear your thoughts. Do you think gold is heading to new highs? Drop your comments down below. Thanks for watching, and I'll see you in the next video.